Hi, my name is Emily Taylor and I'm an Associate Director at Pinnacle Investment Management. As we head towards the end of reporting season, I'm delighted to be joined by Dr. Peter Gardner, a Senior Portfolio Manager at Plato, who manages the Plato Australian Shares Income Fund, to unpack the key themes emerging from Australia's latest results. Thanks, Pete, for joining me.
Thanks for having me.
Pete, let's just start with energy. Both Woodside and Ampol reported recently. Woodside with strong cash flow generation from LNG, Ampol navigating the energy transition. How are you reading the two very different energy stories?
Yeah, it's both been positive for them. Obviously, the Ukraine war has had a big impact on that. So Woodside's profits are up 7% on this time last year. Its dividend was able to increase it by 6%. And so that was all very positive. It's on a 7.1% annual yield, paying out 80% of its earnings, which is its payout ratio going forward. One of the really good news coming out of Woodside is that they announced that they're aiming to reduce expenses by $350 million per annum, which you can see if their profit's $1.3 billion, that's a pretty substantial increase in profit going forward. And we've seen that from BHP when they reported, and also from Woodside, that their cost control is really good on their major projects. So on some of the smaller miners or energy players, we've seen costs blow out on some of their projects, but for BHP and Woodside, they've been able to keep their costs well controlled, and we saw that again in the Woodside result. And so it's positive for Woodside. With Ampol, the profits were even better. Their profits were up 376% on last year to 857 million, and that was slightly above expectations. Obviously, people had been forecasting that as the energy prices, in particular the price of diesel and petrol, have been going up, the refining margins have been going up even stronger. And so, yeah, people knew it was going to be a good result from Ampol, but they paid dividends even higher than expectations. So a payout ratio of just 50%, but their dividend was up 363% to an 8.4% annual gross yield. And so on a payout ratio of just 15%, 50%, then you can see how strong their earnings are at the moment. That would, if they paid out 100%, that'd be on a 16.8% annual gross yield. So very strong result from Ampol. They're continuing to benefit. I just noted today in the news that Russia have announced that they're not going to export any refining margins till the end of the year, or any refined products, so like petrol, till the end of the year. And so that'll keep a floor under the refining price as well, because they export quite a bit of refined products. So yeah, it's all good news for the oil players at the moment. We'll see what happens with the Strait of Hormuz, so you don't want to take too big a positions, but yeah, it's positive at the moment.
Brilliant, thanks Pete. And shifting to retail, both Coles and Woolworths came in with solid earnings as well, demonstrating consistent consumer demand despite economic tightening. How sustainable is this growth given the intense ACCC and regulatory scrutiny over their gross margins? And is the revenue growth being driven by more items being sold, or the sticky inflation?
Yeah, so I mean, their sales for both of them were up about 3 to 4% when you looked at Coles versus Woolies, whereas their profits were up 14% in the case of Coles, or 15.5% in the case of Woolies. So you have seen some margin improvement there, and a lot of that hasn't been necessarily them increasing their prices, but them improving their efficiency. And so they're investing quite significantly on their supply chains and their kind of supply centres that they've got going on, and so they're becoming a lot more efficient, which is driving it. Whether that'll cause the ACCC to look at them further, yeah, we'll wait and see. It's obviously hard to know where politicians are going to go in that regard, but at the moment Coles and Woolies are able to survive that kind of push by the ACCC and increase their margins during this environment. Both of them pleasingly increased their dividends by a similar amount to their profits, so both of them are up 16%. Coles are a bit cheaper than Woolies, so their annual gross yield is 4.7% compared with Woolies on 3.4%. But the kind of one of the news items that's been happening recently, and for me that's got young kids, I know my young kids are pushing me to go and get Ushies, well they were over the last few weeks when it was happening, and so we saw Woolies have much stronger sales in that July, early August period. Their sales were up 7.6%. Coles refused to report their sales because they want people not to focus on the fact that their sales weren't as strong during that period as Woolworths were. But they kind of did say it was consistent with Q4, which is around kind of 3% sales up So yeah, Woolworths did well during that period, but now the Yoshi sale's over, it will probably go back to normal again. But overall, a really positive result for the Woolworths and Coles. And yeah, it's worth noting at this stage of the reporting season that dividends are looking really strong. There's been big increases by BHP Rio, some of the miners, and then that's followed through to some of the consumer stocks as well.
Yeah, dividends are definitely alive and well. So thank you so much, Pete. What's clear is that Plato digs into the fundamentals, balancing both income yield and total return across the market. Plato's dual objective is straightforward, deliver income above the market while outperforming on a total return basis. They do this by actively selecting across Australian equities and rotating in and out of high dividend paying stocks. So since inception, the Plato Australian Shares Income Fund has delivered 9.3% per annum in income while outperforming on a total return basis. For more on equity income investing, please reach out to your Pinnacle distribution team or please visit www.plato.com.au. Thanks very much and have a great day.
Thanks, everyone.